Good morning. Thank you for joining today's daily webinar where we go over your daily questions and we cover certain topics. Today we're going to cover the how to avoid solo 401k confusion. So know the requirements A through Z. Before we get started, make sure to like our video, subscribe to our YouTube channel for more videos like this. This will help to get the information out to other solopreneurs like you. All right. Looks like we've got some questions here. Let's take a look at I've got a question here from Submit. I started my solo 401k in 2024, and I selected I do not wish to have deferrals withheld from my wages and contribute to the plan. Can I still qualify for the $500 tax credit for 2024? You certainly can, because keep in mind that the auto contribution credit, even though it's a little confusing, does allow you to contribute to the plan even if you opt out of contributing. And you will still be able to claim the $500 auto contribution credit each year for a total of $1,500 over 3 years. So in your case, if your plan was open last year, that means you get a $500 credit for 2024, a second one in 2025, and a final one of $500 in 2026. So in short, you're not required to contribute to the plan in order to qualify for the auto contribution credit. Instead, you need to have a solo 401k plan from a self-directed solo 401k plan provider, such as my solo 401k financial, whose plan documents allow for the auto contribution credit, and that other forms are also provided, which we provide to all our clients who established a plan with us after December of 2023, because the auto contribution credit really did not become available until the end of 2023. Which also means that if you're an existing client from prior to 2024, we can actually update your plan so that you qualify for that auto contribution credit, which means that existing clients qualify. We just need to amend the plan to allow for the feature. And therefore, if you have us update your plan here in 2025, for instance, you would qualify for that auto contribution credit starting in 2025, which is $500 in 2025, another $500 in 2026, and a final $500 in 2027 for a total of $1,500. So if you're an existing client and you would like us to amend your plan to add that auto contribution credit, we certainly can. And let me send over our support page where you can submit a ticket for that request. Okay, there's the link there. If you're an existing client prior to December of 2024 who would like us to, prior to December of 2023, who would like us to add the auto contribution credit. So in short, we started drafting the plan documents with the auto contribution credit around the middle of December of 2023 when it first became available. So if you're a client prior to December of 2023, your plan will most likely need to be amended to allow for the auto contribution credit. And again, you're not required to contribute to take advantage of the auto contribution credit. All right, let's see if we have some more questions here before we start our discussion about how to avoid confusion, solo 401k confusion, that is, and knowing the requirements A through Z. Okay. So, looks like we have a question here from Nicholas. Can someone get back to me account opening emails, meet confirmation process review to ensure all aligned because the provided docs are outdated and additional docs for trust did not have their intent interactivity, need to get accounts open, rapidly approaching. Yeah, let me pull up some information here. Give me a moment. Keep in mind that you still have plenty of time to contribute for tax year 2024. You have until your business tax return due date plus timely filed extension. So if you're an S Corp, you have until September 15. If you're a sole proprietorship or partnership, you have until October 15. If you're a C corporation, you have until October 15. So you have plenty of time to open the brokerage accounts or bank accounts and make contributions. So you don't want to be running around like a chicken with a head cut off, knowing that you've got plenty of time to still open the holding accounts and make contributions for tax year 2025. But give us a moment here, and we'll get back to you here ASAP today. Let me put some notes here. All right. Let's see here. Give me a moment here. All right, let's see if we have some more questions here. Got a question here from Morris. Is there any benefit to transferring my Roth IRA from my existing brokerage account to my solo 401k? Great question. Unfortunately, the Roth IRA regulations do not allow for the transfer of a Roth IRA to a Roth solo 401k or any type of 401k for that matter. That's a Roth IRA regulation, and you can learn more about that regulation from by reviewing IRS publication number 560. So in short, not only can you not transfer a Roth IRA to a 401k, you also cannot transfer voluntary after-tax basis in a traditional IRA to a solo 401k. However, you can transfer the earnings and the after-tax to the pre-tax solo 401k, which is common for those who are trying to do a what's called a backdoor Roth IRA. All right. Let's see if we have any other questions here before we continue. Will this be recorded as distributed? So again, the Roth IRA can never be transferred to a solo 401k plan. So even if you took a distribution of the Roth IRA, you still would not be able to deposit those funds to the solo 401k, even the Roth solo 401k. In other words, it's a Roth IRA restriction that does not allow you to transfer a Roth IRA to the solo 401k plan. Okay. Let's So let's talk about avoiding solo 401k confusion, knowing the requirements A through Z. Let me share my screen here. Okay, so it's important to understand the eligibility requirements before you even open a solo 401k plan. So a solo 401k plan is for the self-employed. So those that have an owner-only business that does not employ any full-time, non-owner, common law W-2 employees. A solo 401k can also be utilized by both spouses if both spouses are working in the same business. Let's say, for example, you have an LLC business and both of you and your both spouses are working in that same business, then the solo 401k plan would be set up for that LLC. Both spouses would participate in the same plan because they both work for the same business. Both spouses would have separate bank or brokerage accounts under the plan to hold their respective fund sources, that is pre-tax funds, Roth solo 401k funds, and voluntary after-tax solo 401k funds. In this slide here, you're going to see that it would be a total of 6 separate brokerage accounts or bank accounts because we're talking about 2 spouses participating in the plan. If there's only one spouse working for the business, there would just be 3 bank or brokerage accounts for that particular spouse. So it would be pre-tax, Roth, and voluntary after-tax. Okay, let's keep going here. Now the solo 401k plan, the requirements is that in order to contribute to a solo 401k plan, you have to have earned income from self-employment activity. So what does that mean exactly? Well, you cannot contribute to the plan unless you actually work for that business where you're doing material services, you're doing the work. So it has to be earned income. It cannot be investment income or let's say interest income, or let's say you own some real estate and you get a Schedule E. That would not be considered earned income from self-employment, so that would not qualify. It doesn't matter on the entity type to qualify for a solo 401k. What matters is that you don't employ any full-time non-owner W-2 employees in that business. So the business types that can sponsor a solo 401k plan are S corporations, C corporations, partnerships, sole proprietorships. Let's say you have a farm business, that would qualify as well. The takeaway is that it's got to be earned income, not investment income. What is more, for 2025, the contribution limits are $70,000. That's the overall contribution limit, which means that you cannot contribute more than $70,000. Of course, in order to contribute $70,000 to the solo 401k, you're going to need to report enough earned income from self-employment activity to support that contribution. For example, let's say your self-employed business is an LLC, taxed as an S corporation. Let's further assume that you only report $20,000 of W-2 gross wages from that self-employed S corporation. You're not going to be able to contribute $70,000 because you cannot contribute more than you make. So if you only report $20,000 of W-2 wages, you're only going to be able to contribute that $20,000 to the solo 401k. On the other hand, if you make $70,000 of W-2 wages from that self-employed S corp, there's a way where you can contribute that entire $70,000 to the solo 401k plan, whereby you can treat that entire $70,000 as a voluntary after-tax contribution and then convert it to the Roth solo 401k or to the Roth IRA. Or you can contribute some of that $70,000 as an employer contribution and the rest as a voluntary after-tax contribution. So as you can see, there are many different ways to apply those contribution amounts. But again, the key is to understand that you cannot contribute more than you make, nor can you go over the annual contribution limit of $70,000 for tax year 2025. Of course, there's the $7,500 catch-up for those who are age 50 or older, which means you would need to make more than $70,000 in order to also contribute that catch-up amount. And then there's the super catch-up contribution amount effective for tax year 2025 for those who are age 60, 61, 62, or 63, where they can contribute $11,250 as a catch-up instead of the $7,500. Okay, let's also understand that from a compliance requirement, there's reporting that also applies to the solo 401k plan. For instance, there's a Form 1099-R that would need to be filed with the government and a copy sent to you for filing with your tax return if you process a distribution. For example, if you take your required minimum distribution because you're age 73 or older, we'll go ahead and issue that Form 1099-R if you timely request that Form 1099-R. In other words, we won't issue that Form 1099-R because we don't have access to your funds. So as a trustee of the plan, it is your responsibility to timely communicate to us if you need a Form 1099-R for distributions, conversions, for instance. For example, if you process a mega backdoor Roth strategy where you make a voluntary after-tax solo 401k contribution, subsequently converted to the Roth solo 401k or the Roth IRA, that's going to trigger requiring to file that Form 1099-R. So again, you need to communicate to us when you do those types of transactions so that we can issue that Form 1099-R. Same thing with the Form 5500 Easy. That's an informational return that applies to self-employed solo 401k plans once the market value of the plan is greater than $250,000 as of the end of the plan year. For example, if the market value of your solo 401k plan was greater than $250,000, including all the cash, all the securities, all the funds for both participants in the plan. So if you have a plan where both spouses are participating in the plan, for example, you need to add all those balances together, and if when added together, it exceeds $250,000, that's going to trigger having to file a Form 5500 Easy. That's a service that we provide to our clients who timely request it. Again, we don't have access to your funds, so you need to timely request that from us, and we'll prepare that and file it with the government as well. So the 5500 Easy is a very important informational return. Again, let's say the plan year is December 31st. So if the market value of that entire plan was greater than $250,000, so all the funds and assets in this whole plan are greater than $250,000, and a Form 5500 Easy is due to the government by July 31st of this year, that is 2025, for tax year 2024. So you need to communicate to us so that we can prepare that Form 5500 Easy time before you, because we don't have access to your funds. And as the trustee of the plan, it's your responsibility to communicate that to us. Okay, let's see if we have any other questions for now. All right, looks like we don't have any other questions for today. So we will be back here again at 1 p.m. Pacific time. Thank you for joining today's webinar, and have a good morning.